Good evening, traders and investors. Will back here with another one, coming to you with a Wednesday market recap. Hopefully you guys had a very decent day in the markets today. And in today's action, the S&P and the QQQs largely flat. However, under the hood, many sectors continue to tumble and the volatility remains somewhat sticky because of the continued impacts of the war in the Middle East. Now, of course, we know that recently the markets have been very headline-driven, very sentiment-driven, although the S&P and the Qs haven't moved that much over the course of this week. As we said, a lot of action under the hood. Many fantastic companies still down significantly off their highs, and the market breadth is considerably low right now. We have several different signals firing off that it is going to be a very nice opportunity to buy some of these companies in the market. However, the short-term volatility continues to be very problematic for people seeking to trade the market, as there's a lot of push and pull action on a daily basis, and today was no different. Started off the morning fairly well with a decent CPI print, and then the news headlines surrounding the war in Iran were just a little bit too potent for the market today, and we unraveled the gains and for the most part closed red all across the board. So in today's video, once again, we will be recapping everything for you, as well as our market outlook. Section number 1 of the video, we will be recapping the news highlights of the day. After that, we are going to get into our technical analysis portion of the video, take a look at the S&P, the SPY, and some of your minor sectors, check on the rotation, or rather lack thereof, as of recently, and determine which of these sectors is best positioned to benefit from our buys in the near-term future, and possibly which sectors are to be avoided, at least in the current state of affairs. After that, we will take a look at our big tech names. Big tech not having a bad day. Many tech names were actually higher on the day, as the market is currently searching for safety trades within the grand scheme of the war and conflict in the Middle East. Asset-light companies that are not that much dependent on the price of commodities nor the barrel of oil, have been doing well, as well as certain key themes that we've been discussing, such as defense, energy, and semiconductor connectivity plays as well, just to name a few. So we'll take a look at some of these big tech names and derive which of them are attractive for long-term opportunities, but also derive some levels to pay attention to in the event that you are trying to establish some trade patterns in this market. And at the very end of the video, as per usual, we will go over the biggest gainers and losers of the day, several recurring names and the biggest losers of the day, but also several recurring names in terms of the biggest winners of the day as well. So it should be a very fun and action-packed video as per usual. Like I always say, if you guys want to jump to a certain portion of the video, the timestamps are always linked down below in the video description. So take advantage of them if you want. Without further ado, let's jump right into the action, shall we? So the S&P down about 0.13, the Qs a second day in a row where the Qs are literally like a 0% change, just staying slightly flat. You can notice, though, that the futures market is slightly down right now as the barrel of oil continues to creep up. Now, in terms of the market performance today, you will see that once again, big tech held up the market as best as they could, as financials didn't do too well. We got some news headlines on those as well. Healthcare also nowhere to be seen. And the bottom half of the market, a lot of push and pull here as well. Consumer defensives not doing nearly as well as they did to start off the year. That's largely because these companies have a lot of input costs related to transportation and energy. However, they don't benefit from that much pricing power. And now when we talk about the possible resurgence of short-term inflation, these are kind of the first ones that take a hit. Additionally, some of the industrial companies, such as your defense corporations, pulling back a little bit. Some of the drone plays did well today, but by large and by far, your larger cap players, a bit of a downswing. And to the bottom half of the market, a bit further here, real estate and utilities continue to be pressured because we keep seeing this upswing in these short-term yields, obviously, right? Because of that impending threat of short-term inflation, which will keep the Fed most likely in continuation of a pause mode. That's why the 10 and 20-year yields have been upswinging. And of course, because the risk-free yield is now higher, well, people may not want to take the risk in the real estate nor utilities markets, as the most attractive portion of those markets tends to be the dividend yield. And when you compare them with the risk-free yield, well, people would rather just take the risk-free trade instead, right? Very logical, just Wall Street positioning right there. And the best stocks of the day, which hadn't really shown any signs of life over the course of the week so far, had a bit of an upswing. Some of the oil companies, gas pipelines, etc., coming up a little bit higher. Now, if we take a look at the one-day relative, you can see that even better. Energy and technology were your only safe haven trades for the day. Everything else to the downside. The biggest loser of the day arguably has the most to lose from this conflict, which is consumer staples, otherwise known as consumer defensives on this chart. And the one-week relative performance also shows that energy and technology, the two only trades that have actually gone green on the week, everything else truly to the downside. On the 1 month performance, energy still on top there, and utilities, despite not being favorable this week, still upholding some gains. Technology, not the worst performer, just in the middle right there as the markets continue to display a bit of a downward bias. Fear and greed index right now sits at a 27 as market momentum has been waning as we're crossing below several key moving averages. This one measures the 125. Stock price strength has also collapsed in recent times, a bit low on the fear and greed index right now. Market breadth as well continues to perform quite poorly as this Iran situation has turned into a bit of a downswing for more sectors than one. You'll notice here that the percentage of stocks above their 20-day EMA is down to a very low read of 32. Now, usually when we come this low, it is synonymous with a buying opportunity. It doesn't mean it's an instant buy. It just means that you are likely closer to a bottoming out process, at least in the short term, in relation to market breadth. Percentage of stocks above their 50-day EMA displays the exact same characteristics. You'll see we can take this chart all the way back to 2003. And whenever we come down here into the low 30 prints or high 20 prints, usually a good time to be identifying some very high quality companies that have sold off significantly from their highs, which we talk a lot about on the channel, by the way, and establish some longer term positional buys because we know the market will be volatile in the short term, headline driven, sentiment driven, and percentage of stocks above their 200-day EMA, although has fallen from the highs seen about a month ago in the 60s, it is down to about a 50 read. So definitely no broad market panic right now, as it's more of a grind to the downside, right? No very large moves down, large move downs, consecutive 2% days, etc., right? So before we get into more technical analysis, guys, let us do a quick little rundown of all the news headlines that happened today. And we are going to be covering a lot of headlines on the Iran situation, not to fearmonger whatsoever, not to take political sides, anything like that. No, just to recap the news, the impact on some of the commodities markets, and where are the opportunities right now, depending if you are a long-term investor or if you want to benefit from some momentum trades that have been working very well recently, just to get a sense of when the news headlines come out, how do the markets react to them? What exactly is being priced into expectations right now? That's why we're going to cover a lot of Iran news headlines today, because there were a key few things that happened. Now, number one is the CPI report. So the CPI came in this morning, 2.4 was the expectation, and that's exactly what we got in terms of month over month for February, and core came in at 2.5, which was also the expectation. Now, not much emphasis is being put on the February print because everybody's concerned for the March print, because obviously energy prices have a big factor, a big contribution to play in the grand scheme of the CPI number. So if oil prices persist to be high all throughout the month of March, you can expect the CPI through the month of March to be a little bit higher. However, you do have several key components, guys, that are moving lower. As you guys know, I love using the Trueflation Index right here because it's just more representative than the basket of goods measured in the CPI. Trueflation measures about 15 million plus different products on a daily basis. As you can see, the inflation year-over-year rate is about 1.08%, and many categories have come down over the past year. You'll notice the dark blue category down here, that is food and non-alcoholic beverages. You can actually see it's in deflationary territory right now. Another big contributing factor right here is housing, and housing is the, well, less dark shaded blue area right here. And you can notice if you just follow the graph, housing as well is in a bit of a deflationary territory. Most of your categories right now have been coming down, especially since the beginning of the year. So this is a good thing. Can we see certain blips of inflation come through the pipeline here in the next 2-3 months? We know that oil is a big contributor, but of course, in the Strait of Hormuz, you have a couple different things as well. A lot of input costs come through there in terms of agricultural products, such as fertilizer, such as things like helium, which do contribute to the semiconductor process as well. So many different moving parts. You wouldn't be surprised if this inflation rate does tick up through the month of March and April, but it's all going to be dependent on how long this conflict lasts. So let's talk about the conflict and potentially what the market is pricing in terms of duration, right? So there's a few key big headlines today. Obviously, this one we got to talk about, guys. Oil prices have been becoming the key driver of equities. Now, this is not always the case, as I'll show you on the graph, but the 10-day correlation between the S&P and WTI crude oil futures is down to minus 0.6, the most negative reading since October. Now, this usually flares up in times of conflict during the Middle East, but back in 2022, when Russia invaded Ukraine, you had a similar situation whereby equities really started following a negative correlation here to the price of oil. Now, the correlation is not always perfect, but in times of conflict, when that's the entire focus, of course, you would expect there to be a heavy negative correlation. Every time the price of the barrel moves up, equities go down, et cetera, right? So you can see that it's a heavy negative correlation period right now. And the last time that was the event was in October, and also back in June and July. June and July was the initial strikes on Iran, by the way. And through the month of October, you had a couple different things, more things out of Israel and Iran, but also the China tariff situation too contributed to a slight uptick in the price of oil. So oil is driving the current market right now in terms of sentiment, in terms of expectations, and as you see, in terms of the market breadth, it is bringing down more things than one. There used to be a lot of rotation, which we talked about during January and February. That rotation has kind of stalled, right? Now the money is coming back into a couple different things. Safety trades have been some of the defense contractors, some of the oil companies, of course, and largely a lot of tech companies have come back. Not so much software, that's still mixed, but semiconductors and especially big tech, who have some of the best balance sheets in the entire markets right now, they have been a bit of a proxy for a safe haven. We're not saying they're skyrocketing, we're just saying they're not plummeting as much as the rest of the market is on a daily basis. So speaking further about building on this correlation, the reason that it matters is because we want to see how the price of oil is responding to any short-term catalysts that may come out of the news cycle, such as this one right here. The IEA is going to launch the largest ever oil release from the global strategic reserves. We talked about this yesterday. The G7 countries are meeting and discussing whether or not they're going to release some of these strategic reserves. The decision came today, releasing 400 million barrels. Now, 400 million barrels in terms of the context of everything, right? That would give us some decent supply, some decent supply output here through about the end of March. If the conflict were to persist beyond the end of the month of March, that is when you actually start going negative in terms of the output out of the Middle East versus how much strategic releases are being released at a current moment, right? So this would put you through the end of March. Now, how did the futures contracts react to this very big piece of news that the market's been anticipating since yesterday? Well, as you can see here, guys, right, the price of the barrel of oil didn't really do much today. It went down on the release of the SPR news, right, the Strategic Petroleum Reserves. It went down, but still closed the day higher. And now in the futures market, we are additionally up 3.28%, reclaiming some of the hourly uptrends as well. First time we've been closing above the EMAs since that big crash happened Sunday evening through the Monday session, right? So the barrel of oil not responding, not essentially getting crushed to the downside, which means the market is pricing in a longer duration to this conflict, not seeing it being resolved, at least not in the next 2-3 weeks. That is why that happened, right? So your April contracts for the barrel of oil right now currently sit at $90, which was roughly around the closing price of today. But as you see, as you move down the futures market here, May is also quite sticky. But as we come into July, August, and September and October, right, that's when you see some sequential decline. So if the pricing here is relatively even across the April, May, and June contracts, that is essentially the market trying to price in that maximum duration, maximum effects of the contract in terms of closely being tied into the forward contract 1 month is extending about 3 months for now. So that's the market giving you a range, right? The conflict is likely to be solved either between the next 1 to 3 months. If not, these longer dated contracts would indeed be a lot higher than they currently are. So that is the market's expectation right now. If you deem that to be wrong, that's up to you. I'm just telling you guys how the futures market are trying to price in everything that's going on right now. Moving on further, we had more releases, this time from Japan. Japan announcing some oil reserves in terms of private oil releases as well, about 80 million barrels privately, but also in terms of the government will be releasing their own reserves too. Japan has about 254 days worth of reserves, which is good enough, but keep in mind, some of these Asian countries, especially Korea and Japan, right, get about 90 to 95% of their oil from segments around the Strait of Hormuz. So these two big pieces of news, okay? A lot of the European countries and the rest of the members of the G7 agreeing to release some of the strategic reserves. Japan with their own set of strategic releases today. Still, the price currently of the barrel of oil being largely unaffected, right? You got to take note of that, right? To where these headlines were hitting, and now the market is basically saying, we might think it might last a little bit longer than that. So these news releases are not hitting the same as they might have maybe on Sunday to Monday evening when you had kind of peak volatility and at that moment, peak oil for the time being at least, right? Now, Headlines today included something like this: Iran striking a Thai ship that attempted to pass through the Strait of Hormuz. There's been a lot of discussion in the last week and a half of whether or not ships would actually try and make the attempt. Several ships have tried to made the attempt. Some have gotten through over the past few days, but the strait largely remains closed to about 95% of traffic. This was one of 3 container vessels, or rather oil container vessels, that was struck in the strait today. At the same time, right, so this is a negative piece of news that the market reacted to today. At the very same time, over the course of the afternoon, we have some insurance news here, because we know that Iran previously wasn't enforcing, until about 2 days ago, where they weren't striking boats going through, right? Now they are. Now, the reason that the strait was closed last week, it essentially was closed in theory, was because no insurers wanted to insure the cargo that was being put through the strait, which prompted President Trump to say that maybe they're going to have to issue some private insurance of their own, and they were looking for a partner. Well, now they have a partner. Chubb is partnering with the U.S. International Development Finance Fund on a $20 billion reinsurance backstop aimed at reviving shipping in the Strait of Hormuz, right? However, do they actually want to go through, even if they do have insurance, if you might end up in a situation like this, right? Getting a drone or some form of a torpedo onto the ships, right? So that's not a very good event, but still something to look out for. And even this news right here, people are waiting for insurance, did not necessarily move the price of the barrel of oil today, right? As you saw, it ended higher. All things to pay attention to, right? That's why we go through these news headlines to gauge what is the market thinking, right? Is it thinking that because we're releasing all these good elements today, such as the strategic reserve release and the insurance, well, would that have been enough to bring down the short-term price of oil? The short-term answer is no, not yet. So it just lets you know that maybe we're going to have to start pricing in a little bit more longevity for this conflict, even though the U.S. is making a lot of progress. Now, the U.S. Navy has refused near daily requests from the shipping industry for military escorts through the Strait of Hormuz, per Reuters. The details include the U.S. Navy says the risks of attacks is too high for now. The U.S. Navy has held regular briefings with shipping and oil industry counterparts. During the briefings, the U.S. Navy has said it's unable to provide escorts for the time being. Sources say that as of Tuesday's briefing, the risk assessment has not changed. So as you can see, you're getting the strategic oil releases, you're getting the insurance as well. You're getting the insurance, which is very good. However, the Navy still unwilling to escort ships through because the risks are too high. So you can have all the insurance in the world, right? If the military risks are too high and you can't get an escort, maybe the shipping route is still not going to be open, or at least fully open for now. Moving on a little bit further here, we're skipping into something different, right? Another negative catalyst that is plaguing the market right now. We've talked about this many times over the course of the past 6 months, but more specifically over the course of the past 2-3 weeks, as we get more and more headlines, right? Some of the bearish catalysts, obviously Iran right now. Okay, we've kind of forgotten about the AI paradox, haven't we? We've kind of forgot about the Mag 7 capex spending, haven't we? Now the focus is on Iran, the soft jobs data that came out last Friday, and the private credit concerns and bankruptcies, right? These are your main 3 factors, but they are all in effect. This is in the background right now. But they're still there. You haven't necessarily solved that in terms of market mechanisms so far, right? So in terms of private credit, take a look at these headlines right here. JP Morgan forced to mark down loans and has decided to reduce lending to private credit groups. Blue Owl, Blackstone, BlackRock, and now JP Morgan. Obviously, these are the companies that were that were facing credit risks, right? A lot of exits in terms of private credit funds, either BlackRock redemptions or Blackstone redemptions, Blue Owl redemptions as well. Some of these companies are trying to put caps on redemptions from their private funds. And now JP Morgan saying that they're forced to mark down loans. That news headline hit financials pretty hard very early on in the day, which led to a big portion of the financials sell-off, or continuation of the sell-off today, which is why many stocks in this industry were down. The biggest components that were down once again remain some of the asset managers, so keep that in mind. Additionally, too, this one came out in the afternoon here, guys. Another private credit alert right here. $33 billion Cliffwater private credit fund limits redemptions to 7%. Okay, 7%. Again, as they hit 14%. So they're doing half now. So redemptions, right? And we've covered this topic many times. It's the whole issue of cockroaches in the system. Now we know that the major banks are very well capitalized, and the financial system overall is very well capitalized. However, you can't put a price on sentiment sometimes. It's just like a month ago when you saw the mass exodus from SaaS companies because of the Claude headlines. People just wanted to go shoot first and ask questions later. That's exactly what's happening in private credit right now. You haven't seen very many blowups at all recently. 2 last October and 1 about 3 weeks ago in the UK, which was a mortgage lender, a subprime mortgage lender. But now people are racing for the exit without asking questions, right? So keep that in mind. Moving on a little bit further, which is why financials have been down, right? Moving on further, here are some technical statistics for you guys. So now that we know that the sentiment is very negative right now, volatility is remaining high, the markets have a bearish lean, the news cycle is obviously very aggressive right now. Well, what does history tell us about statistical events such as these? Well, right now, what's the smart money doing? What's the dumb money doing? Well, obviously, you guys probably know what the dumb money is doing, right? Ever since February, with the SaaS sell-off, etc. Well, unfortunately, this little box here is kind of covering the graph, but you can kind of extrapolate, right, that retail was fully loaded about mid-February, and then retail is just racing for the exit door. However, you can also extrapolate, if I just move my big head out of the way, you can extrapolate that the smart money line, okay, this box is slightly transparent, you can't see it, but just follow my mouse. Smart money, well, they had not been accumulating this time, but now that retail's been dumping, look, now it's finally flipped again. So again, retail panic selling to who? To the institutions who have been buying all of this stuff, right? So just something to pay attention to as, oh, my head's in the way of the flip again, right? So now the flippening has happened again. The last time that happened, that retail dumped and the institutions bought, well, it was this bottoming out process here in October. And then when it finally recovered, that's when retail was a bit late to the game. They started buying from who? From the institutions that had bought the big dip back in November and October. And I'll remind you, that was this piece in the markets right about there, okay? So once again, the flipping here on smart money versus dumb money. Something else, right? Risk on, risk off indicator. A lot of retail sentiment in this one as well. A lot of people have pivoted to risk off right now. You can see that in the put call ratio. A lot of people buying insurance. But just to let you guys know, obviously the CNN Fear and Greed Index measures a lot of different things. However, if you want to dive a little bit deeper here, this risk on, risk off indicator does show you that, well, when you're usually in a period of risk off like this, yes, it means that there's turmoil in the market, but is also synonymous with several periods of time where you can find local bottoming out effects. A bit more on that too. Hedge fund short positions in the U.S. macro products, including index futures and ETFs, are up to 11% of U.S. exposure, the highest since the 2022 bear market. So a lot of hedge funds are short index and ETFs. However, they are very leveraged long stock. That is the long short. They are long stock. However, they are short indexes, futures, and ETFs as kind of a macro hedge overall. So they're picking and choosing the stocks that they want to be long on. However, issuing broad market shorts in the process, which is why your short ratio has crept up to the highest exposure it was in the 2022 bear market. More statistics right here. Put delta at a historical extremes. You can see the put delta right now is at minus 70, which is very strong. That just means that a lot of people have been buying insurance recently, right? So we're kind of trying to tie all the loose ends together, cross the T's and dot the I's. If many people are fearful in terms of just pure sentiment, hedge funds are shorting the indexes, but very long individual names. This one shows that yes, some institutions have puts as hedges, but a lot of retail has bought puts at the bottom and bought puts when the VIX was super high. You can see that by the negative delta positioning here in the market, which means the dealers have all the short puts, not the long puts. No, you bought them from the dealers. They are short the markets, which is why it's so tough for the markets to drop, right? Because the dealers are obviously hedging that exposure right now, which is why it's been frustrating to get some short form follow through, right? They're just not paying it right now. Moving on a little bit further, it's bad out there. Sentiment is downright awful. Take a look here. Another sentiment indicator. Excessive optimism was the chart all the way up there, and excessive pessimism is obviously when we're all the way down here. You will notice that usually when we get towards these lows, it tends to also mark and denote a short-term local market bottom, right? The last one that we saw was previously in October and November, right? That was this little spike down next to the green circle that we're in right now. Prior to that was the Liberation Day event. Prior to that, this other spike where my mouse is right now, that is the August, the August 2024 Japanese yen carry trade unwind, and so on and so forth, right? So we're approaching peak negative sentiment right now, at least if you measure kind of like a structural average here over the course of the past 20 years. More This comes as all of this short positioning, bearish sentiment and whatnot comes as the Mag 7 names are the cheapest that they've been since April 2025, Liberation Day, and the Q4 2022 bear market bottom. That is measured as an expression of their earnings right now. You can see right now we are well below the mean, and usually when we have come down here, at least the last 3 times over the last 4 years, these have been very attractive locations to buy some of these companies, which is why we spend so much time talking about some of the Mag 7 names and their respective valuations. So once again, right? Pay attention to this, guys. There are many factors that are kind of screaming the alarm bells right now if you follow the media cycle. But when you look under the hood, there's a lot of deep value down here. We're triggering certain segments, whether it's the breadth, whether it's certain statistics that I've already showed you, right? A lot of things are telling us that we can be positioned as buyers. And in the medium to long term, beyond the volatility of this conflict, of course, you will be heavily rewarded for buying down here, which leads me into the last piece, which we'll conclude about. Goldman warns of a potential extreme stock rally. Goldman Sachs' John Flood says hedge fund positioning could fuel a sharp stock surge if good news emerges. Speculative bulls have high gross exposure, 307%, so leveraged, while heavily shorting ETFs and index futures, the long-short combo that we've talked about, creating right tail upside risk. A ceasefire in the Iran conflict or positive headlines could trigger 2-3% index gains as macro shorts unwind. Market volatility remains high due to war, AI, credit fears, and thin liquidity, while corporate buybacks support equities. John Flood notes that stocks need a resolution signal soon or risk further stress, a further grind down in the price, right? Very tough for the price to absolutely collapse when you have all that put positioning in the market and dealers taking the other side of that trade and obviously hedging in the process too. So all of that news cycle to kind of just paint the broader picture of where we are right now. And just to recap everything for you guys once again, right? The conclusion is the exact same as yesterday. But if you're watching the channel for the very first time or you missed yesterday's video or Monday's video or last week's videos, I'll recap it again, right? We do want to be, if it's a long-term portfolio, guys, it's very simple. There's so many high-quality businesses, whether Visa, MasterCard, American Express, Amazon, Microsoft, Facebook, so many different companies, solid companies at very low valuations that can indeed be bought in these current times because historically it's been a great time to buy these companies at these low historical valuations. We're talking about companies with very strong moats, very strong competitive advantages, great balance sheets, great free cash flows, great growth in earnings, and great growth in revenue as well. Very consistent and very predictable companies. Long-term portfolio, very simple. You really want the market to stay down and out as long as possible so that you can accumulate at these lower prices, 10%, 15%, or as much as you can of your paychecks into those high quality companies, or if you are an ETF investor, into your compound ETFs as well, right? That's the easy part for the long-term portfolio. I'm pretty sure everybody gets the point by now, yeah? However, if you are trading the markets right now with all the choppiness, with the barrage of headlines, and with all the current themes, we have to play the themes that have momentum. If we are playing the wheel strategy right now, like me, I'm waiting for days where the VIX spikes, where we have rapid and sharp moves down in the market, possibly like tomorrow, and as a result, we can find some beautiful short put entries significantly below the market on our high quality stocks. Until the time that they give you those opportunities, you may as well just sit on your hands. Monday was one of those days where we got a lot of opportunities in front of us. We were able to take profit later that day or into Tuesday, and now we're sitting back on the buying power and waiting for those opportunities to arise once again. If you are trying to swing trade these markets to the upside, okay, with shorter duration plays, well, you need to be playing where the money is going. And we talked about that yesterday, spent a lot of time at the end of the video describing some of the energy trade right now, some of the drone and defense manufacturers right now, some of the critical minerals plays as well, and some of the second order effects of AI, the data center connectivity plays, especially a lot of the photonics names right now, memory names right now as well, right? Very specific themes. Well, a lot of you guys potentially want to play the oil theme overall too. So a key few players in there, obviously everybody knows about the oil companies, but if you take a look at the year-to-date gains, you'll notice a couple new players here. CF Industries, LyondellBasell, and Dow Inc. What do these three companies have in common? Well, take a look at the charts right here. That's not cotton futures. CF Industries, what do? Agricultural chemicals and fertilizers. Dow Inc., although Dow Inc. doesn't only do agricultural chemicals, right? There is a component to this business that does it. They are up heavily, as you can see, from the beginning of the conflict, right? I'm not saying that you have to play these names. I'm saying if you are a momentum trader, a short-term trader that enjoys playing current themes, current narratives while they last, these are the names that you should indeed be looking at as well. Of course, there's many more. And then LYB, another company, right? LYB, that too, since the start of the conflict, has been higher, reversing a lot of longer-term downtrends in the process, right? So I'm not saying you have to play them. I'm just pointing out that the money is rotating to some of these plays. It is still in a lot of the energy names as well. It is still in some of the defense corporations, whether they are the larger cap defense corporations right here, where the chart still looks great, or some of the smaller ones that we presented yesterday at the end of the video, such as some of the drone companies, or either the critical mineral companies with a military component to them, right? There's a lot of different things depending on the type of trader that you are, right? Those are the ones, if we're looking for shorter term swing trades, you got to play momentum right now. Okay, trend continuation trades, not trend reversal trades. The trend continuation trades are the ones that are working the best. If you're just waiting for trend reversal trades, trying to pick the bottoms on Nike or something like that, it's just not going to work, right? Not in this current market environment. You have to follow the money, the sectors that are benefiting right now from either the conflict directly, which is sad to say, obviously, right? Such as the oil plays, such as the fertilizer plays, chemicals, et cetera, right? Or military defense spending and things like that. Those are trend continuation plays. Far easier to play than going for the ever so elusive trend reversal plays here, or trend reversal plays on names like Bitcoin, and just waiting. You may as well play the trend is your friend if you're a short-term trader, right? So if you're selling premium, be patient. When the opportunities arise, you strike. You get very deep strikes on the market with high volatility. You get a nice market bounce. You take your profits, you get back into cash. That's exactly how I'm playing it. So there's many different ways to play this market. There's definitely something for everybody, whether you are a long-term investor or a trader. And what I try to do on the channel when we go through all these news headlines is try to bring it all together for you, because I know there's different types of people who watch the channel. That's everything for our news segment. Another very long news segment with a lot of statistics, a lot of different news. But I'm not just reading the headlines, right? No, it's being able to establish the links between the headlines that's going to try and help you guys out the most. So hopefully you guys enjoyed that. Now, let's get into some charts, shall we? So first off, as per usual, moving on into the S&P 500. So the S&P still in a daily downtrend, still a lot of volatility, still a massive amount of chop. The daily candles don't look that big, but within the candles, there's a tremendous amount of swings either direction, right, on any given day. So please keep that in mind. Support stays put down here, 673 down to 666. If you flush that, you may as well be heading to the 200-day EMA. Interesting fact, the futures market actually tagged the 200-day EMA. That was the sell-off Sunday evening into the Monday pre-market. It did tag it. In the event the SPY loses level, you're coming down a little bit further, and that will be a top to bottom sell-off to the 200-day EMA of only 6%. It just goes to show how tight the market has been with all the various forms of positioning in the market right now. So sentiment is definitely one thing, right? But positioning is another. You got to know how a lot of the institutions are positioned right now, how a lot of the dealers are also hedging the market, which has kind of left the market a little bit locked in this current position right now. The short-term bears are still in control. The narratives are still in short-term bearish control as well. You're going to need something big if you want to reverse this trend overall, such as Goldman Sachs was highlighting in this article right here. But there is definitely a lot of pressure. In the event it does happen, the shorts will be unwound very quickly. So just pay attention to it. If not, if you're trading, you got to stay nimble, right? Moving on to the QQQs right now, still gridlocked right now in the resistance range, 613 down to about 605. A lot of the tech names have been holding their own. However, if we erode into tomorrow's session, you can revisit these structural lows again. 596 down to about 591. The 200-day EMA is down here at 587. Fun fact as well, they did tag this one in the after hours and pre-market session Sunday into Monday. If you do revisit, that would be a top to bottom decline once again of approximately about 7.4% on the actual QQQs. So please keep that in mind, right? We are only going for monthly higher low back tests here, still in the context of a monthly and yearly bull market right now, but it's been a very passive past 5 months for the market, that's for sure, as we've moved through all these various bearish narratives one after the other. Moving on to XLF. Well, XLF still has the private credit risk headlines that are affecting it right now. A little bit overblown in my opinion, but also in the opinion of several other key analysts. Now, that being said, it doesn't solve our short-term price action issues. As you can see, we're still below our support, or now resistance area, 51.50, down about $50 psychological resistance. The XLF ETF right now is down 12% from local highs and almost 10% year to date. Down here is a fantastic entry location, 48 down about 46. That is the entry that I'm personally playing with some short puts overall. It is great support from previously in 2024, and we're just looking for a clean support structure to be established here as we move lower and lower. Daily almost going to be oversold. So definitely if we make our move down into there, which is why I've been targeting it with some short put contracts, right? Selling puts for premium down here. In other words, when we do embark on the XLF, it doesn't do it that often, guys, but whenever we embark into short-term daily oversold conditions, you can get a structural bounce. It doesn't mean price action resolves completely to the upside. It just means that at least in these daily oversold locations, you can get a very nice bounce. So as a result, if we're trading down there, we come down into there, that is the profit that we're looking to make essentially from some of these bounces. You can see that even in the context of downtrends right here, when you come into daily oversold conditions like this, right, you can get some nice bounces, which is really all you need. A couple days worth of bounce, cool down the VIX, and then pretty much you're able to realize that premium. So no short-term directional trades for me in terms of XLF, just selling premium down there overall. But still, also, if you are an ETF investor, have been looking to get into financials, several key themes, or if you want to invest in the XLF ETF overall, I would be looking into this area too. But also, if you're an individual stock investor, right? Visa, MasterCard, SPGI, Moody's, things of that nature, JP Morgan coming down nicely as well, Bank of America coming down nicely as well, American Express also at very attractive locations too. So pay attention to a lot of these companies, right? They're offering very attractive entry levels if you are a long-term investor planning to hold these stocks for the next 5-10 years, well beyond the confines of this current conflict in the Middle East or the private credit headlines currently afflicting the markets. Moving on to healthcare right now. Healthcare trying its best to hold on to the support range down here, 153 to 151. No signs, though, of any daily uptrend shifts. For that, you would need a break of 154.31. Not having it. In the event that you forfeit this region, you're probably coming right down here, the 12 EMA, and you will fulfill the prophecy we've been talking about for the last few months, right? Looking for a monthly structural higher low, monthly downtrend, beautiful cup and handle right here into the pocket between the 12 and 26 monthly EMAs. You go back in time, usually when you find those types of pockets, it has been a tremendous location to be buying the healthcare sector overall. That's the area that I'll be looking to position in myself if it comes down there. I haven't had healthcare positions now for many months. Last time was buying leaps here, exiting here, and both here. And now I'm waiting for their re-entry trade after being patient for a while. So pay attention. If healthcare breaks down with the rest of the market, this location right there could be quite interesting. Again, that's 148 to about 145. Moving on to semiconductors right now, holding their own, 0.93% to the upside. Daily, nice engulfing move right now. But if these moves in the market, you can see the futures right now. If it proves to be too strong, guys, right, it's very possible that you can erode these short-term movements. They are your lead bull. But the market momentum right now, the narrative is building currently and can be also very strong. So please pay attention to that. You're at equal lows on the weekly. So 374 is your line in the sand level for the bulls to protect. In the event that you unwind this move over the next week or so, you're heading into monthly consolidation, the extent of which can probably be found in the 360 to about 340 pocket as the monthly EMA curls up. It would just be a very nice test of the monthly 12 EMA, which we have not done in many months at this point in time. So pay attention to it. They are your lead bull, but we have been overbought for a while. Several key names that I still enjoy. Marvell on a pullback, right? There are many ways to play semiconductors, right? But I'm watching Marvell for a possible pullback in terms of restructure right there. I'm looking at NVIDIA, a breakdown and pullback to the 170, 165 location. I'm looking at AMD for a potential retest here of the sub 200 prices. Many different ways, and also Broadcom after their phenomenal earnings. If they break down again and they provide some entries in this big box where there's a big arrow right here, 300 down about 285, decent location. So many different opportunities across semiconductors. Those are just a few. So pay attention to the entire industry if they do get pulled down. Moving lastly into the Russell, which we analyze on a daily basis, right? Daily, still in the context of a downtrend. They are battling with support right now, 250 down about 246. So please pay attention to that. No daily uptrend as of yet. That will be a breaking close above the recent high, 257. Short-term bears are still in control. Obviously, if the SPY and the Qs don't cooperate, don't expect growth stocks to cooperate either. Bearish lean now, weekly downtrend, daily downtrend, and also monthly consolidation. So pay attention to this pocket right here, guys. 240, touch of the 12 EMA. That would be the likely retest location and where we would be more interested in building some longer duration swing trade longs if you're looking to play the IWM Russell yourself. Moving on to the VIX. The VIX currently still hovering around 24 right now. Curious to see, right, with the increases of the price of the barrel of oil here in the post-market session and the declines in the Qs and the S&P also in the post-market session right now. The VIX, you do have a decent chance of the VIX popping higher, which is great if you're looking to sell premium. We know that when the VIX is elevated here between the mid-20s all the way into the 30s, phenomenal location to be patient. If some of your favorite names, I'll just give AMD as an example, because that's the example that I gave on Monday, right? You see a 4 or 5% decline on AMD tomorrow, high VIX, that'll open up some strikes way deep down here. As I gave the example on Monday for AMD, it gives you some phenomenal distance on a phenomenal company with great premiums, targeting about 0.5%, right? Usually when the VIX is this high, right, you can find some of your favorite companies, not all. The volatility on them has to be fairly decent. You can find ridiculously low strike prices on a lot of these companies. That's how I'm playing the VIX, right? Whenever the VIX has a spike and companies come down in a rapid fashion early morning, I sell some put options down there. When the volatility tapers back a little bit and you get a little bit of a bounce, well, obviously you can then close the contracts for a decent profit. So if you're an option seller, you're probably loving these market conditions right now, especially if you're being very patient. Moving on into our further analysis here, talking about gold and silver. Gold not really doing too much at all. Line in the sand on gold right now is about 5,000. Lose 5,000, you lose the daily uptrend attempt, daily downtrend, and just further weekly consolidation. Pay attention if that happens, how it reacts to the 12 EMA, something we have not lost for a very long time at this current stage. That is your short-term momentum guide. It tells you that the bulls are still in control of this move right now. Still though, no action on gold recently. I'm still long. However, if you break down structure below here, 48, 85 roughly, that's when the longs need to be paused a little bit, because that's when you might expect a little bit of a deeper monthly retracement. So the bias short-term is still bullish, but you got to monitor the short-term price action. Don't be caught in a larger monthly reversal. Same thing can be said about silver right now, right? So they tried to make the attempt for the daily uptrend. Now the bears have a turn, right? What you want to see at least is a tightening range or reestablish an attempt for a daily uptrend. This one is going to follow gold. So the price of silver right now, the chart is very, very, very messy. It's not clean anymore. It's very messy, right? So it's going to follow gold. Pay attention to the 12 EMA as well, right? Trying to establish some higher lows on the weekly here to persist in the weekly uptrend. But if gold doesn't follow through, do not expect silver to follow through either. No weekly closes below the 12, right? Gold is still far off the 12. You'll notice that silver right now has challenged it a few times. Pay attention if that price action breaks down, because the last thing you want is to be trapped in a larger form monthly consolidation on some of your swing trade longs that you might have established recently. So please keep that in mind. Oil, I mean, I guess we'll cover oil. Why not, right? Big resistance up here, 110, then about $100. That resistance has been in effect for a very long time, challenging it above here in 2008, challenging above here in 2022 with Russia, Ukraine, and challenging above it more recently too. So please keep that in mind for the price of oil. Big downswing into the Sunday market, right? Into Monday morning. And now we're kind of sitting in between. Look at this weekly candle. So awkward, right? So drilling down to the short-term price action, few key structure issues right here. You'll notice we came below the EMAs for a long time. We were not able to reestablish much of in terms of short-term hourly uptrends, but that has since changed over the course of the day today. More recently here, right? So now you see the new uptrend being formed above the moving average. The release of the SPR didn't help it. The release of insurance contracts, partnership with Chubb, didn't help it either, right? So that being said, oil might be able to challenge the psychological $100 level again. If you're trading oil, got to trade with the stop loss, right? Below the most recent lows. Tight stop will be down below here, below 86. Short-term price targets, of course, $100. And then you're going to be targeting the 110 psychological, just below our former peak. And obviously, if you're trading a bit wider, well, the stop loss on the 4-hour time frame at least would be right down here, 82, and then you would be targeting the absolute peak right here if you're trying to go for maximum expansion, if you have a very bearish lean, and that's how you want to hedge against the markets, or rather participate. That is how you would play it. Pay attention, MACD cross as well, right? They can get on, obviously, guys, this one's prone to headline risk, right? Any number of headlines can come out. over the next couple of days, which could either skyrocket this further or significantly have a negative impact on it, right? So you got to be nimble. You got to trade this with the stop loss because it's going to move very violently in either direction, very prone to headline risk right now. In either direction is the barrel of oil. So keep that in mind. Moving on to Bitcoin and Ethereum, we're not going to spend too much time on this because nothing has changed, right? Still locked at the short-term price levels right now. 74,000 at about 66,000 is your range. Line in the sand for the bulls is 65,501. If you somehow attempted any swing trades right now, that's your stop loss area because longer dated time frames here, guys, excessively weak. No bounce whatsoever by the bulls, so it could be interpreted as a bear flag. And if you do follow through on that bear flag, 60 down about 55 is the next location. Same can be said about Ethereum, right? Unable to break into resistance, 25 down to 2100. Risk off market right now. Crypto, no love whatsoever. No money movements into the sector whatsoever. Dearly out of favor currently right now. And the bulls unable to establish any form of daily uptrend. Weekly could also be interpreted as a bear flag until they show you that they mean business, right? Give me consecutive daily uptrends. So far, no sign of that. Possibly still another bear flag similar to back here. And if you do break down lower, you are heading right down here, 1760 to 13. I don't have any swing trades on crypto right now, only very long-term positions. So keep that in mind, right? I have no short-term horse in this race whatsoever. Just reading the price action for you guys because I know a lot of you guys pay attention to it. That's it for our overall market breakdown. Hopefully you enjoyed. Now let's dive into our big tech names, spend about 10 minutes on these, and then we'll get into the biggest gainers and losers of the day and rehash some of the themes we've been focusing on. So we're going to move through these a little bit quickly because not much in terms of the price action has changed, right? Apple, first off on the list, 256 down to 245 is support and above resistance, 266 to 277. Apple has been holding up better than a lot of other companies in the market right now, but no short-term direction, right? A little bit trendless right now, although the bears are in slight short-term control of market right now in terms of the Apple chart. The best time frame, in my opinion, is the monthly, right? Similar to the SPY, similar to the QQQs, Apple has come down consecutively here over the course of the past 4 or 5 months, trying to establish a clean higher low. So if we are looking for any swing trades, maybe we should be approaching the position here of about 245, 240. That is the sweet spot pocket. Big monthly cup and handle here is on deck right now. Apple should be having some very interesting product releases. They've already showed us the new MacBook about a week ago at this current time, and the iPhone sales are quite good as well. So Apple, more resilient than a lot of companies out there. I'm not adding to my long-term position because the valuation is a bit expensive, but if I were exploring some swing trades or some things of that nature, right? Probably down here is a better gauge, or rather, about 5% lower is an area that I'd be looking for us to come down in a rapid fashion, maybe hit some oversold conditions and wait for the price action reversal, something like this, maybe on a smaller term time frame, right? You wait for the daily uptrend, we can position at the lows here and possibly go for a bit of an upswing here on Apple, so long as the general indexes are conducive to those types of moves. Just something that I'm exploring in the future. Of course, we'll cover it day by day, but as of right now, no swing trade opportunities for me on Apple. Moving on to AMD right now. AMD, same concept as a lot of the. I use this one as an example, right? You can see in the pre-market, or rather post-market, whatever you want to call it, overnight futures is down 1.3. AMD is just locked as well, right? 229 down to about 216 overhead resistance, and 190 down to about 178 is current support right now. My favorite way of playing AMD in terms of trading, when it comes down into the lows, I'm looking to sell some put options way below the market, guys, like 170, very deep, which would be the full OpenAI gap fill, by the way. That being said, monthly downtrend in effect right now. We are currently just consolidating some of the higher time frames right here, such as the quarterly time frame. That being said, short-term price action, very messy, right? Just following the broader trends of the market right now, in spite of the fact that AMD's thesis is very much alive. It's not going to do anything, guys, until the broader market starts to show some signs of risk appetite and some signs of the conflict ending, right? It's really just a higher beta version right now of the indexes currently. It just moves in line with the indexes more or less. That being said, valuation is very fair right now. So if we're looking to accumulate any AMD shares for late 2026, 2027, 2028, I'm always a big fan, guys. Under 200, more specifically, closer to like the 190 region down to 170. This little pocket right here, very solid because the valuation is quite conducive to some nice expansion here for AMD over the next 2-3 years as they expand into their big growth cycle, which we've been talking about on the channel right now for about a year, right? It's in effect, and it is coming Okay, deep 2026 into 2029 and beyond. Moving on to Amazon right now. Amazon also just struggling right now, right? So although Amazon has been doing all right, over the course of this week with all the volatility, still no signs of completion of the breakout pattern, right? We are looking for the bulls to gain a bit more ground, but as long as the price action right now in the markets is very messy, Amazon's probably not going to get some lift. So as a result, my favorite way of playing this one is if we come down in a big fashion back down to the lower 200 range, once again, selling some puts down here under 200, such as the 195 down to about 190 area. So pay attention to that one. Doesn't mean it's going to go down there, just means with great volatility and rapid early morning declines, you can find some short puts down there. In terms of long-term advantages for Amazon, of course, you guys know the business is firing on full cylinders right now. 1.35 peg. Amazon, DCAing with the paychecks, still a big fan. There's going to come a point in time where I can't DCA Amazon anymore, right? When it starts moving past 240, 250, 260, whenever that does occur, I can't DCA it. But here, all the way through like the 190 range, very attractive location in my opinion for this company overall. Currently still in a phase of monthly consolidation. A lot of these big tech names, right? Just establishing some monthly downtrends right now and just establishing some quarterly price action trend reversals into here, into just consolidation, beautiful consolidation areas on the longer term time frame. So if you have a longer term view, these should be no-brainer buys. It's just that if you have a short-term view, it's very tough to swing trade them because as you can see, there's just a lack of momentum follow through right now across the whole cohort of large cap growth names. Moving on to Google, another fantastic company that is just beholden to the current price action and current market sentiments of the overall broad market right now. So bears daily downtrend still in effect, trying to go for the lower high attempt right here, still unable to break above our moving averages, which we recently lost, which is when I said, when we noticed this breakdown right here after earnings, I told you guys the regime has changed. Okay. Previously, for the past 6, 7, 8 months, right, it's been holding the daily 12 and 26 EMAs. When that broke, you already knew you're going into weekly consolidation, now a weekly downtrend, right? And also monthly consolidation was highly likely as well. The next stop for Google, if things really break down in the markets, is right down here, about 276, 260. That's the area that I would be looking at for any further swing trades. As of right now, no swing trades on Google for me. I think they're a little bit in no man's land in terms of price action structure areas. And also the valuation down there at 300 is still a little bit elevated for me to add any long-term shares. Keeping in mind, the last time that I added, I stopped adding above 180, right? So I don't necessarily need more Google shares up here. I'm also not selling any because it's a phenomenal company. It's just the price action has been similar to the rest of Mag 7, right? Just extended consolidation phases over the past few months. Moving on to Meta right now, another very strong company, however, with very unfavorable price action. Meta's done absolutely nothing in the past few weeks, just hovering around here, 660, 650, etc. Below 645, 630 is your support range. In the event that the bears prove to be too strong and you embark on the daily downtrend and flush the level, well, you're clearly going back down to the big boy area of support, which is 605 to 552. My favorite way of playing Meta, again, is not going for the short duration swing trades like this necessarily, but if we get higher VIX and a decline on Meta, you can see they're down 1% in the after hours right now. Pull back hard into this level, you'd be surprised how deep you can get on some short put contracts if you have a large account and you want to play Meta that way. If you're a long-term investor, still a very decent area to be averaging in 2 more shares, as we know that under 660, the valuation is more than fair in my humble opinion. It's just going to have to be patient, right? Moving on to Microsoft right now, another fantastic company with unfavorable price action. The daily uptrend is still in motion right now. Higher lows is about 389. So Microsoft benefited from the overall software move off the lows. I mean, it's not a very crazy move, right? But even on IGV, that was like a 15% move off the lows. It looks very small in the context of where we came from, right? But even Microsoft had a decent bounce off its own respective lows. We will see whether or not this 7.5% bounce will hold up. Microsoft right now stuck in support, right? Between 409 down to about 386. The bounce size, not very strong so far. So you need to see further continuation of this move. That'll give you a better indication of, hey, if we can bounce a lot higher and get maybe up to about 433 before, you want to see the daily uptrend do something like this, right? Move into the 618, 430 up to 444, move into the 50%, 60% retracement range. And then if you lose the daily uptrend there, you're like, okay, the weekly bounce has been very good. And then we can maybe look for some swing trade longs. As a result, we'll have further weekly confirmation and you'll be able to say, okay, more than likely the monthly lows are indeed set. And we may be looking for a more structural move, a more progressive move higher out of this long phase of monthly consolidation. that has not happened just yet, right? So you're still a long way away from being able to say, yes, these are your pure monthly bottoms. That being said, although Microsoft isn't displaying any short-term nice characteristics for short-term swing trades, it's displaying all the characteristics of being a great long-term investment, trading right now at below 25 forward price to earnings, and very close to the monthly 50 EMA. Microsoft almost never tags that monthly 50 EMA. And if you just look in terms of historical context, buying it on the technicals here while having a very low valuation, usually a good recipe for longer duration success. Moving on to Netflix right now. Netflix embarking on a bit of a consolidation phase of its own. Beautiful rally from the bottom. Let's be honest, guys. That was a huge move, right? 33% from the lows. Bulls getting a little bit tired here, overbought conditions, and now embarking on the good old consolidation phase right now, right? So the end of this current support range right now is about 90. You can see some confluence with these shorter term moving averages. They put in a lot of distance, right? This is the type of move you would want to see on Microsoft. From the most recent lower high, that's a 618 move. And this is what I mean, right? The bulls have created so much space that they have a lot of room here to set some higher lows into maybe 90 or maybe a revisit of the high 80s, and then reestablish the medium-term price action structure. And on this decline, that's when I'll be looking to take advantage of these declines in the high volatility to sell some put options down here, right? Because now you'll be able to establish this form as a local tradable low and go for some swing trade high. So be patient for it. Netflix trade is maybe right around the corner if they give us a decent enough retracement, and that'll obviously be for the reset of the monthly timeframes, claiming that this is indeed your monthly structural low and that you may be looking for a more structural progression. But be very nimble in this current market, guys. Be very patient for your opportunities and wait for the price action to show you. No guessing, no speculation, right? Just watch the price action because you know it's a very headline-driven market. Look at the futures market right now, down about 0.75%. We'll see if that lasts in the overnight session. On to NVIDIA right now. NVIDIA, not too bad of a day today, but unwinding most of that in the futures market right now. Daily uptrend underway, but let's be honest, right? There's just no progression of this chart whatsoever. Solid company, beautiful earnings, but just stuck here, right? It's not going to be stuck here forever, but for the time being, it indeed is. My favorite way of playing NVIDIA, just as I say on all the other companies, you get a rapid decline early morning with a high VIX. Then that's going to be a great opportunity to sell some put options down here, because I don't care if I'm assigned NVIDIA at 165, when at that point it'll be trading under a 20 forward price to earnings and already under a 1 peg. I don't mind. Give me the shares down there. I'll gladly take them, especially if that's synonymous with a 12 monthly EMA touch and 6+ months of consolidation. So that's how I'm playing it. Long duration shares or long duration leap contracts as some averages into there. Decent proposition in my opinion, because they're not short-term trades, right? Anything long-term right now, you're either selling premium with volatility, or I'm building longer term directional trades. Nothing short term for now because the price action isn't conducive to that. So keep that in mind. Tesla, decent day, 2.15% to the upside, trying its best to reclaim some of these moving averages. It would have been nice to see them close at the highs, but that was not in the cards. Reacting from resistance, 425 down about 416. So Tesla is trying to make a daily uptrend attempt right now, but if the markets prove to be too strong to the downside with the narratives, with the momentum, it's just not going to happen, right? So keep that in mind. Stop losses on this daily uptrend break. If you guys were interested, we talked about it yesterday. Stop losses need to be maintained between below 385, because the last thing that you want on a swing trade attempt for a reversal of not only the S&P, but also Tesla, which is going to carry from that, right? The last thing that you want is to be unwound into the lower area of support, which is 360 to 335, right? You'd rather take the stop loss right there. Didn't work out. Price broke down. Now we reassess and wait for a similar pattern structure down here, right? So that's what you're going to be looking out for. Pay attention to that on Tesla right now. Tesla just moving in line with the rest of the QQQs. Moving on to Palantir right now. Palantir up 0.3%. Beautiful daily uptrend, a lot of space off the lows. Coming back into our support range right here, 147 down to 140. I'll be very curious to see how Palantir reacts to this region, because we've claimed the short-term moving averages. We're above a key area, pivotal area of price action structure, right? It's not the biggest one, but it's one of the biggest ones that we have that's close to the current price. I'll be very curious to see, can the bulls play defense here, establish some higher lows, and go for it, right? Very curious to see, or will Palantir give back a lot of its gains and just plunge to the lows? because we are still in the context of a weekly downtrend. It's been an okay bounce so far, but if that's the end of it, that's a 50% bounce. So the bulls have some room to manage for a weekly uptrend reset and price action structure, right? But got to pay close attention to it. No short-term trades on me for Palantir right now. I'll be curious to see how we react from here on the shorter-term timeframes. But so far, nothing from me. And obviously, we know the valuation, right? I mean, when we did the valuation after earnings at about 135, we established that a 2-peg for Palantir is relatively fair, especially considering that they used to trade at a 3.5, 4-peg, right? And now, as we've waited for earnings to progress and some decent declines, down here is not that bad of a price for Palantir. Here at about 150, I mean, it's only about 10% higher than right now, but still that would put it at about a 2.3 peg. If you can find it around 135 again, 130 or below, that may be a nice time to buy further into the stock, provided that you have a very long-term time horizon, of course, because you are paying for years and years and years of forward growth at these multiples. Moving on to SOFI right now. SOFI being bogged down with the rest of financials, right? At the end of the day, we can say what we want, but SOFI is a bank, and it's been trading like a bank, right? So, I mean, if the XLF, okay, of all your major banks, I mean, this is obviously higher beta, right? But the trend is the same, okay? They're a higher beta component of financials, but a financials company nevertheless, right? So don't expect SOFI to come back up as long as you're dealing with these private credit headlines. They may not be SOFI specific, but if they're enough to drag down SOFI, the credit card, like if Visa, MasterCard are not coming up from here, if some of your financial data companies are not coming up, like SPGI and Moody's, if the banks are not coming up, well, you're not going to expect SOFI, which trades at a elevated multiple in relation to other banks, right? They trade at like a 31 forward price to earnings, which is fair for SOFI's growth, but still, right? You're not going to expect a higher beta stock in the grand scheme of financials to rally if no financials are rallying. It just makes perfect sense. So the way that I enjoy playing SOFI right now is 2 parts. Number one, I'm selling some put options into support on any big red days. Maybe we get one tomorrow. It'll be a great opportunity for me to try my hand at selling some put options, 16 down about $15. This was a top 5 options play on Sunday's video. So pay attention to that. If it comes down there, nice opportunity. It'll be the deep monthly retracement down here into huge price action areas of support. Definitely want to take advantage of that. And also pay attention to, adding to the long-term shares. I know a lot of you guys like SOFI, and I do as well. If it comes down there, that'll be the first time that I add to my SOFI position in a very long time. Of course, this is a multi-year thesis on the stock. It's been having some short-term volatility. The bears are still very much in control. Until you see a new daily uptrend, the bears control the daily, they control the weekly time frame as well, and your monthly consolidation is not finished as of just yet. 2 last ones right for the moment. Uber getting some nice news today. Uber partnering with Amazon's Zoox for multi-city endeavors, right? Another nice partnership under Uber's belt right now. They popped a little bit, right? But the bulls are still very soft right now. So if they get carried down by the overall markets, you can expect a price erosion right here. And as a result, if you just look at the weekly time frame, right? This weekly bounce is nothing to scream home about. It's an okay bounce, but nothing to scream home about, right? Most of the price action traded between the, let's just call it, I mean, it never even closed the daily up here, right? Most of the price action was barely a 38.6 bounce, right? So that being said, soft bounce, still holding support. If we are long Uber with a swing trade from these levels, you got to put a stop loss down below here, below about 69.5, right? Because the last thing that you want is to get unwound from very powerful bears that are in control of the weekly time frames, okay, and the monthly time frame for the time being, and send you back down to the mid 60s. So keep that in mind. However, Uber from the low 70s to the 60s, great opportunity. I haven't added to my long-term Uber position in a very long time. Give me under 70 through 60, and I will consider adding more to my long-term Uber shares, as down here under 75, more specifically 70 to 60, it starts to get really cheap. Under 20 forward price to earnings, under a 1 peg. That would be like under 68 and below, right? So watch out for it. Phenomenal companies in this market right now to be building longer term positions in. It's just for short term swing trades, you got to be very careful, especially if you're playing some of these, because all or most of these plays, whether it's Tesla, whether it's Palantir or whatnot, they're trying to go for the weekly trend reversals. You got to trade those types of plays with some stop losses, guys, because until the trends are actually changed, the bears remain in full control. It's a counter trend trade. That's why you call it a trend reversal trade, right? So don't get ahead of yourself in those types of trades. Taiwan Semi up 2.15% on the day. So nice engulfing move. almost an engulfing move, 358, right? However, just like SMH, guys, if the overall market direction proves to be too powerful for even some of these semis, they will come down. I'm pretty sure nobody's concerned about the upside here, but a lot of people are concerned about the downside. So let's talk about the downside possibilities on TSM. Yeah, downside possibilities would be a revisit of some of these weekly lows. That would be a full unwind here of this weekly move and would lead you into further monthly consolidation. TSM has not touched the 12 EMA in a very, very long time. Does the market currently have the conditions to make that possible? The short-term answer is yes. It has all the conditions to do it right now. Doesn't mean it will. It just means that if we are patient enough, maybe, just maybe, TSM gives us an opportunity. Low 300s would be a touch of the 12 EMA at a bit of a more manageable valuation. Down there at 310, you'd be trading at like a 22, 23 for PE, and the PEG ratio would be down closer to like a 1.2. That would be very interesting. I'd be adding to my TSM position and also looking for some key swing trade entries if you do give that full retracement. If it doesn't do it, no problem at all. As I keep saying, there are many other trades currently available in the market right now for us, depending if you know where to look. So that's everything for your overall market rundown and your big tech name list. Now let's spend 10 minutes. And today, I swear, I will spend 10 minutes covering the biggest gainers and losers of the day. Okay, so I'll do these individually today. So essentially, the way that I'm going to structure the biggest gainers and losers section is yesterday and the day before, we talked a lot about themes, right? Today, I'll be going just through the names individually. I'll kind of pick and choose certain ones that I kind of want to talk about. If you want to see my recaps on the themes, key themes in the market right now, Monday's video at the end of the video. Yesterday, we spent about 25 minutes on it as well. Today, I'll just be talking about some of the biggest losers, right? So number one, you got FICO down here, down another 9%. Now, this is a 2-day, or rather 3-day, if you want to count this entire week so far, 22.5%. Now, FICO has always traded a little bit rich, right? And today is no different. They still trade a little bit rich. The reason it's been down so much, guys, is because of the ongoing competition between them and the issuers of the Vantage score, which would be Equifax and also TransUnion, right? So whereas before FICO had an almost outright monopoly, now it's looking more like a duopoly with the Vantage score, which is why this stock has been down so much. Now, I have no doubts in my mind that this stock is a long-term compounder with very nice net margins and very strong free cash flows. But whenever you have an industry, or rather a player that was previously a monopoly that now has to share its market leader status with another competing product, well, the pricing power kind of diminishes. And the entire reason for FICO's rally this entire time was the fact that they almost had exclusive pricing power and took it upon themselves, right? In the context of a very strong housing market to perpetually raise their prices and more and more and more and more. And now that pricing power has kind of come down, which is why you're seeing a very large structural downswing by FICO right now. So the next stop, in my opinion, right here, $1,000 psychological would be nice for this stock to actually get a stock split. So I don't own FICO personally, but I'm not here to say that it's not a bad long-term investment either. It's just not something that I hold in my own long-term portfolio. The financials names that I hold, some Canadian banks, Visa, MasterCard, SPGI, Moody's, I own some of those, but no FICO, right? So that being said, not a bad play per se, but still very unfavorable price action right now. So short-term swing trades, definitely a no, but adding to any long-term positions, I mean, you're back to like 2024 pricing, not that bad in my opinion. The valuation has come down a little bit here. Talking maybe next about CSU for anybody who's interested in CSU, a Canadian software player out there. They specialize in certain healthcare industries. Basically, they buy smaller form software companies out there and implement them a little bit better, turn around the businesses, make them more efficient, and just keep the same customers essentially, right? So it's a very nice business model that did wonders for years and years and years, but obviously with the new Claude agent system and everything like that, the company is sold off in a phenomenal fashion right now. So I have one little share of CSU that I bought at about $3,200. Obviously now I'm underwater. I'll consider adding another one. If we do break down again towards the 2,000 level, then I'm kind of done for this play. I think it does have a good chance of recovering. Most of the price targets are back here in the 4,000s. I don't own many software players out there, but this is indeed one that I'm starting a very small position out there, guys. So just pay attention to this one if you're interested. Very rare for it to come down into monthly oversold conditions. Actually, the first time in the company's public history that it's doing that. You can see it might come back down to weekly oversold conditions as well. And as a result, guys, the trend has been out of favor. But for longer term buys that may have a good chance of being, well, they'll probably have a very good chance of being rewarded in the future. This is my play, right? Some of you guys are buying ServiceNow. Some of you guys are buying Adobe. Some of you guys are buying Salesforce. This is my only play that I'm truly buying right now. Other than that, other considerations for software, talked about it many times, right? Cybersecurity, either a cybersecurity ETF or your favorite player, cybersecurity definitely has the most expansive total addressable market in the future, and definitely can't be vibe coded away, right, or taken over in-house by a lot of companies out there. It's kind of an irreplaceable technology for a lot of companies in terms of doing it on their own in-house. Talking about AVAV a little bit, so we're not going to spend too much time on this stuff, but AVAV, they had their earnings yesterday, and unfortunately, the earnings disappointed, right? 5% miss on EPS and a 14% miss on the expected revenue. Obviously, that was because of something that happened a few weeks ago, the $1.5 billion contract that they had with Space Force, which is a component of their business, right? They do military purposes for actual battlefield applications, but they also had a fairly big contract, exclusive contract with Space Force, which hasn't yet come into effect. Now, Space Force has reopened the bidding, and as a result, the companies had to remove that $1.5 billion from their backlog, which has left a bad taste in some people's mouths, but also a negative effect on the stock price right now. AVAV is a company that I do own, and I would not mind owning more of, especially if you come back down here into the lower 180s level. This is a multi-year play. I don't care what happens to the price action in the short term. All I know is that I'm buying a company right now, 10 to 8 billion, with a very nice exit rate in 2028 of about $3.43 billion, right? So I'm going for the long-term play on some of these drone companies, which do include AVAV. I have a little bit of KTOS as well, and I will be adding to the KTOS position between the $80 and $70 range. If we do drop down there, I also have OSS for some edge compute. I have AMPX for batteries for a lot of the aerial drone purposes as well, some of the smaller drones too. So I have a couple military plays going at the same time right now well, they're all in the military complex, but many different aspects of playing that military complex. So just something to pay attention to. A lot of people were, talking on social media about the AVAV earnings and whatnot. But if you're a short-term investor, of course, the price action is going to hurt. If you're a long-term investment, phenomenal buying opportunity down here, in my opinion. And when I say long-term, guys, I'm talking about you got to be willing to take this company from an $8-10 billion market cap to 20-30 over time, right? It's going to take some time. Nobody's expecting a massive rally back to the $400 price range immediately, right? No, it's just we're getting a phenomenal discount, and I've been waiting for a long time to start a position on AVAV, and now that they're offering me prices that you have not seen since 2024, I'm a big fan of taking advantage. Speaking about some of the nuclear plays, I don't own any nuclear plays directly, at least not some of the core plays such as CEG or CCJ. However, I do own the utilities players that also employ nuclear power within the grand scheme of also a lot of other things that they do, right? Such as NextEra Energy. Now, NEE, I'm waiting for the back test. I already have some positions now, but waiting for the further back test down here of the mid 80s. I think it's phenomenal. And shout out to Vistra as well. Vistra is going to be a cyclical winner, right? These energy plays that we're doing, either nuclear specific or broader utilities in relation to the data centers, it is also a 2-3 year play, guys, right? The bottleneck for energy has not happened yet. You got to wait for the data center constructions to be up and running, right? These companies obviously have tremendous pricing power and tremendous installations, and will be building more installations over time. So utilities, specifically more oriented towards either renewables or natural gas outputs or nuclear, right, are going to be very popular. One way of playing nuclear, if you don't know what to buy, right, are some of the nuclear ETFs, NUKZ and or URA. URA has a bit more speculative holdings as part of their top 10, whereas Nukes, I think, is a bit better distribution if you're just looking for hardcore utility players, not so much speculation. And by speculation, I mean the URA ETF has I forget what it is, 7 or 8% exposure to Oklo. You know what I mean? Whereas NUKZ, I mean, we're taking you through the top exposure right now, I guess, which is why it's one of my favorite nuclear ETFs right now. So I hope it's going to load quickly because I don't want to spend too much time here. We got other names to kind of cover right now. Let's move on to the holdings. So you can see here, right? Top holdings right now, CCJ, CEJ, LMT, GE Vernova, PWR, Curtiss-Wright, Rolls-Royce, which also does nuclear too, Honeywell, et cetera, right? Whereas your URA ETF has the exposure, some heavy exposure here to some more speculative plays, right? You can see here Oklo is about it's 6.6%, whereas 24% is in Cameco directly. So very big concentration in Cameco, but then they have 6.6% in Oklo. So I'll let you guys be the deciders as to which nuclear ETF you want. I have a penchant towards NUKZ. URA has the higher beta, right? Because of the concentration in terms of Cameco, and then the Oklo exposure, which does well when the stock's moving higher, but not so well in other words. If not, my favorite utilities players that also have a bit of nuclear are NextEra Energy and Vistra. Moving on a little bit further, I mean, I guess we could talk about consumer retail, right? A lot of these companies have input costs, and a lot of their input costs are transportation, which does eat into margins. When oil prices are high, you get the fall offs, right? Which is why On has been coming down. I mean, it's the first one on my list. May as well talk about it. Phenomenal company, right? But just I'm not interested in a lot of these plays. I'm just not interested. Nike, you can see significant fall off here from 65 down to 55 in the last few weeks since the conflict started because of the input costs, right? Which is why XRT is an ETF, right? Your retail ETF. This one is more balanced than XLY. XLY has so much direct exposure to Amazon and Tesla, which are like 40, 35, 40% of the ETF. You know what I mean? XRT is more balanced to where no position outweighs 2%, but if you take a look at the balanced ETF, it'll just tell you, right? Everything in consumer retail, I mean, just look at the ETF holdings. I mean, this is how you should kind of frame some of this stuff, right? If you want to know what's going on, whether it's restaurants or whether it's, you know, some of the shoes companies that we just saw, like ON and things of that nature, right? You can see, right? No company has more than 2% exposure here. So there's Kroger, there's Target, there's Five Below, there's Ross Stores, Dollar General, but obviously there's many, many more holdings than that. And it goes into Nike and some of the restaurants, et cetera, et cetera. It's consumer retail. Very easy, yeah? So I'm not really interested, guys, in consumer retail because right now the inflation narrative against the market because of oil, et cetera, because of consumer pricing power, all those things have not been resolved as of just yet. So even though Nike can have a great recovery cycle, I'm just interested in playing different things. There's so many other more predictable companies on the table right now, whether it's Mag 7 or if you're playing thematic, right? If you're playing thematic in terms of consumers just waiting for the recovery of the consumer, you might be waiting here for a long time, right? What I'm playing thematically are all the companies on the flip side of this that have been doing very well, right? The neo cloud providers. We talked about some of the energy plays, some of the military plays as well, right? Some of the bottleneck plays such as SanDisk, such as Micron, some of the photonics plays such as AOI. You're playing the trends, right? You're playing the trends, and they've been easy, right? So far, like TE Energy has had great expansion off the lows. Kraken military play, which we have as well, great expansion off the lows. AMPX, right? OSS, which we already covered, Micron, and et cetera from the lows. So Bloom Energy also from the support area that we were highlighting. So these are much easier to play rather than just sitting there in consumer retail, you know what I mean? And especially for longer duration portfolios, like long-term investments. I mean, the Mag 7, a lot of them are trading at low forward 20s multiples. So it's like, what am I doing here buying Chipotle or like Kava? You know what I mean? Or even Celsius, you know what I mean? Or Nike or the other ones. Like, what are we doing here? You know, there's so many other higher quality, like Visa, even Visa and MasterCard trading at low 20 forward multiples. Their business models are far more resilient and far less cyclical than plays like Nike or Chipotle or things like that, right? Not that those plays are not good. You will see me play them eventually, as we played them many times in the past, but just not right now. If we're looking for momentum, okay? If we're looking for thematic trades, not long portfolio positions, I mean, for consumer retail, a lot of them, right? They're not really good in my opinion right now. There's other better companies for long portfolio positions right now, and there's better thematic trades for thematic momentum plays right now, right? So it's kind of like Nike or the restaurants, they don't fit in any box right now. They don't fit in short-term momentum and short-term narratives, but they also don't fit in the long-term portfolio box because there's many other higher quality companies that are available at arguably equal price to earnings metrics or equal PEG ratios. And you need to look no further than companies like NVIDIA or companies like AMD or companies like, you know, Amazon or companies like Meta or Microsoft trading at low 20s forward multiples. So I'd rather add to those than start a position on Nike or something like that. There'll be times to play consumer retail. I'm just here to say right now, in my opinion, there are many better opportunities in the market right now, but take from that what you will. Obviously, you know, you guys are free to have your own opinions right there. Brookfield, another phenomenal financial company that's been coming down right here into the 26 EMA. Brookfield between 40 and 35, in my opinion, is indeed a buy. This is one that I added to my long-term portfolio early January. At about this local range right here at about 43. If we come down a little bit lower, guys, I'm definitely adding some Brookfield. Long-term portfolio hold for me. Shout out to New Holdings as well. Another financial player that's been coming down recently. Down here about 14 to 13. Sweet spot, in my opinion. Big support range down there. And also very strong bull case for 2027 and 2028. That one is very interesting. Phenomenal growth metrics right here, right? And also not a very cyclical business whatsoever. So I'm a big fan of that one too. Just going through the list here, trying to find anything. We talked about Axon too. Axon will be exploring a longer term portfolio position here. If we break back down under 500 down to 400 would be a pocket that I'd be looking to build a position here. Same could be said about AAP11, excuse me. If we get another dip on AAP11 down here, low 400s to buy. I know many people are contemplating Reddit right now. Decent also. I have a more of a penchant towards AAP11 down here in low 400s just because of how cheap this stock actually is for the growth and, you know, massive amounts of margin there for this company as well. I think that's it for the downside. I mean, we could talk about the upside a little bit. Obviously, NBIS, you guys already know the news. No need for me to comment. NVIDIA with a $2 billion position in the company. This one got helped by two things today. Oracle earnings yesterday, which showed the data center trade is very much alive. Cloud infrastructure trade is very much alive, right? And also they got the big news from NVIDIA today. So two-part trade. I've been very firm on saying that I enjoy these data center players, right? You might remember me several times in the past few months, whenever NBIS was down here, 90 down to about 70. That was the buy location for me. So hopefully you guys were able to get a piece of that. Iris Energy down here, 40 down to 30, not too bad in spite of the recent dilution, $6 billion. CIFR, I know a lot of you guys are bullish on CIFR. We keep saying, right, 14 down to about 11. I know it's a wide range, but you're looking to play the monthly consolidation phase on this one. So there are many very interesting opportunities, right? CoreWeave down here, 70s, also very decent. I'm very picky on my CoreWeave buys because we know they have a lot of debt, but the data center players, guys, this is a multi-year thesis because as we covered Oracle earnings yesterday, last year was the funding and hype cycle. Now you're using all that funding to build the data centers. This is the execution layer, the boring layer. And in the future, these companies will have the data centers operational and making money from them, right? So now we're in the middle of the phase. This is the accumulation zone, otherwise known as their own company's execution layers. So don't be surprised if the price action on NBIS continues to be choppy. If it comes back down there, no problem at all. Continue nibbling a little bit more through that accumulation phase. I think that's it. Some of the names like Klarna has been actually destroyed. You guys know my stance on buy now, pay later. Affirm is my favorite player for a couple different reasons. Their client quality is a bit better. Their loan quality is a little bit better. Their delinquency rate is far lower than something like an Affirm or otherwise. Affirm down here, very cheap valuation in my opinion, 50, down about 46. I enjoy playing this one on the wheel. No leap call positions for me right now. Also no swing trade positions for me right now, but I am playing the wheel on this one. Next wheel entry position, lower 40s. I'm always a big fan of playing Affirm. I think they're the best buy now, pay later player just because we're going through it. Intel also very decent right now. We're in a bit of a swing trade in the Discord group ourselves into Intel. Stop losses would be the breaks down below the lows right there. But Intel's doing a great job of maintaining these positions, right? So not too bad of a move here on Intel. Continues to be a nice position here because of the government trade, obviously, and Intel's recovery story being underway. And a little known fact, Intel's been working on a lot of glassware technology for substrates, for wafers and whatnot, which has been heavily helping them because they're kind of getting some of the love of the photonics, optoelectronics plays because of their work in that segment overall. So keep that in mind. That's a bit of an X factor kicker for Intel. It's what they spent so much money. They burned so much money on that technology over the past 4 or 5 years. They're getting a bit rewarded from it, even though they don't have a working product for it. At least they're kind of advancing along that stage right there. And I think that's kind of it with the rest of the stuff we already covered, right? You guys already know my stance on critical minerals. Pay attention to them. USAR, UAMY, they're going to be coming up many, many times over the next few months, quarters, years, as we seek to undo the reliance on China and seek to do more of that within the continental, North America overall, right? Sourcing them from either Canada or the United States directly. And I think the other ones we've already talked about for the most part, so we're not going to go through these again. Obviously, we'll do more of this as we continue moving on through the week, whichever names are on the highs and the lows. But I think I've done a good job, guys, of covering most of everything, right? We talk about software on a regular basis and what I like, what I don't like there. We talked about consumer retail today, what I like there, what I don't like. We talked about consumer staples and the rotation down because of the impacts of inflation and transportation costs and limited pricing power of those companies. We talked about the energy trade. We talked about the fertilizer trade today. We talked about the current favorable themes in the market, military, drones, some of the energy components therein, right? I think we talked about financials and why those are down too. So I think we've pretty much covered a lot of things. We've talked about the fact that many companies are in great fundamental locations to be buying, such as the Mag 7 names, et cetera, et cetera. So I think we've done a really good, some really good rounds, right? In terms of market, we've covered most of all sectors, my views on them, my opinions. You guys are free to take from that what you will. If you disagree with them or whatnot, I'm just here to provide some insights as to the market rotation, what's currently working for the market, what's not working, some key themes to pay attention to. So hopefully you guys enjoyed today's video, another long video, but in times like these, there's a lot to talk about. So better keep you guys updated with the trades and how I'm playing the markets, long-term portfolios, different ways to trade the markets as well, right? So hopefully you guys enjoyed the video. If you did enjoy the video, consider dropping a like and subscribing to the channel. Would really appreciate it, guys, because these videos are very long, and so they're not favored by the algorithm, but I know you guys like them. So if you like, comment, and subscribe, it definitely helps me out to get these videos out to more people. And please feel free to leave a comment down below if you have any input whatsoever. If you guys are looking at any plays, definitely love to hear about your plays down in the comment section. And just love hearing from you guys in a general fashion, of course. And last but not least, guys, I know these markets are very challenging right now. I know they might be very confusing, and it's kind of information overload. If you are tired of trading and investing in the markets all by yourself, you may consider joining our group and trading and investing in the markets as part of our group and having a lot of fun in there as a whole, right? So the link to join our group is down below in the video description. In that group, you get access to a few things, of course. You get access to all of my trades in real time, whether they are the premium farming strategies, right? Any wheel trades that I fire off on a daily basis, whether they are the thematic trades, small cap plays, leap call contract trades, long-term portfolio positions as well. I share everything that I do in my portfolios with the Discord group on a daily basis, and you get access to all of it in real time. You also get access to our private morning live streams. Every morning, Monday to Friday, I stream live for about 2-3 hours. We trade the markets live, and then I also take all of your questions on your stocks, your options, your long-term portfolios, questions on the market overall, questions on key themes, ideas. We get into very good discussions during our live streams, and that's the best place to ask me all of your questions on a daily basis. You also get access to all of our educational section. I have like 15 hours of private content that I'll never put on YouTube in terms of various trading strategies, how I pick my leaps, call debit spreads, put credit spreads, things like long-term portfolios, how to build a long-term portfolio, how to build a trading account depending on your risk tolerance, how I do my technical analysis, fundamental analysis, a whole educational section that our members really enjoy. And of course, you get access to our chat rooms, but also you get access to all my watch lists, all these watch lists that you see on a daily basis, and all my charts. I keep forgetting to mention that, right? But all my charts, whenever you guys see charts with fundamental annotations or annotations of support and resistance levels that I usually update on a weekly or monthly basis whenever they kind of rekindle or establish new price action levels, right? And all the fundamentals on hundreds of companies, you can just copy paste all of my watch list, all of my charts. It makes your job a little bit easier. And that's pretty much most of the things that you get, but feel free to explore the benefits in the link down below in the description. I would love to have more of you guys in there with our group. So if that's something that interests you, feel free to join. And if not, I guess I'll see you right back here on the channel. That is it for me, guys. Take care. Have a good evening, and I will see you tomorrow after the close as usual. Peace.